So for those of you who haven't met me, I'm labeled. This is the great thing about Zoom. I'm Cynthia. I'm a partner at Farella, and I'm in the private client industry group, which is part of our family wealth. Well, it's our family wealth group, but also our private client initiative. And the focus on my practice since the early 90s has been on exempt organizations and nonprofits and philanthropy and charitable planning and all the different angles at which people try to make the world a better place that is different than doing it with a profit motive. So I love my practice. I love my clients. And many years ago, I started this seminar series as a way to bring conversations about contemporary issues and topics that are of interest to nonprofits in a networking kind of atmosphere where we could all learn from each other. And so it's evolved. And as I was saying to the other speakers, I was a late adopter to the webinar format. I really prefer seeing people in person so we can end the day with a glass of wine and some snacks. So in lieu of that today, when we finish the program, for those of you who want to say hello to people and have some kind of, casual conversation, I'm certainly going to stay online for a while. So feel free to hang around and just to chat if you're tired of talking about insurance and risks. One thing we do, I have always asked for in these seminars is I really want your feedback. I'm not sure how it's circulated now, but I know that Margaret gets an evaluation form out to everyone. We really do want to get feedback. So please do provide that. And if you have topics or ideas for a future seminar, please be sure to make that known to us either by a separate email or however you want to convey it. Because as much as we like to talk about what we like to talk about, I'd also like to put out seminars that people are interested in attending. So the other thing on my note that I wanted to mention with this expanded format across the country, we're focusing on this from a California law perspective. So for those of you who are in other states or practice in other states, some of what we say will be irrelevant to you, but California is the center of the universe, so that's where we speak from. So before I go into our case study, which will start us off, I want to introduce my co-presenters for those of you who don't know them. Joan Dove is a leader at Gallagher Risk Management Services in their nonprofit practice, and she has over 30 years of commercial lines, underwriting, marketing, and brokerage experience. Joan is nationally known for her insurance and risk management expertise with nonprofits, social service agencies, museums, educational institutions, and youth organizations. She's been a top 20 producer for Gallagher and is known for being innovative and resourceful on a myriad number of insurance issues. Risk and Insurance magazine named Joan as a national power broker 5 times for her work with nonprofits across the country. She's a guest speaker at numerous conferences and events on risk management, reducing insurance costs, and protecting the reputation and assets of nonprofit organizations. So you can see we're really fortunate to have Joan here today. Thank you, Joan, for all of your prep work and your work with Mary and I in putting this together. Mary is my partner here at Farella, and she's a senior partner in our insurance recovery group. Mary is nationally recognized as an expert on a variety of insurance coverage issues. She's one of the founders of and the past president of Mercy College of Coverage Council. Mary and I have worked together on some really challenging coverage issues for claims against nonprofits. And Mary also helps me in reviewing insurance packages before the fact when we don't yet have a crisis. So Mary and I put together a hypothetical to start us off here, which as I read through it, I realized that this is my version of starting the program with a joke, except it's not really a joke because pieces of this have happened. We've seen this. So here's we'll call it a hypothetical, but it's not really hypothetical. This all happens. A charity hosted its gala fundraising event at a director's estate. Parking was limited, so shuttle buses were going to be used to transport guests from a central parking location to the site. The weather was uncertain, as it would be anywhere in California. So the host director arranged for a tent with seating for several hundred and an informal agreement that the charity would pay for it. On the eve of the gala, the CEO discovered that the staff special events coordinator had been embezzling funds and immediately terminated her. The fired coordinator shot off an angry email to the entire board and a local media outlet stating that her termination was unfair. Her conduct was attributed to extreme distress resulting from harassment and bullying by a board member. The CEO quickly cobbled together a group of staff and volunteers to work with the outside special events coordinator, who was, by the way, a close personal friend of and hired by the now terminated staff coordinator, so that the coordinator would finalize and run the event. The CEO discovered that the staff person, had dropped the ball on a number of tasks that she had discussed with the outside coordinator, but decided to do herself to save money, which included hiring a transportation service and supervising the tent installation. A transport service couldn't be found at the last minute, so the CEO arranged for volunteers, including the other directors, to shuttle the guests in their cars. The outside coordinator agreed to arrive early and supervise the event. On the evening of the event, one of the directors came early to help set things up, including opening the bar. He then began to shuttle passengers, but for unknown reasons, he lost control of his SUV, ran into the tent, which collapsed because the installers had arrived late and were rushed by the outside coordinator to finish the job before the guests arrived. Unfortunately, the installer missed a key anchoring pin, which caused the tent to fall over when the SUV ran into it. Guests inside and outside the car were injured, fortunately more frightened than anything else. But the tent, when it fell down, seriously damaged an extremely valuable sculpture on the lawn that was borrowed by the director from a museum. The CEO reports that, as when the CEO comes to Mary and me, that supposedly there is a contract with the outside coordinator, but she hasn't seen it. Much to everyone's surprise, the day after the event, the director on whose property the gala was held realized he'd forgotten to pay his homeowner's insurance premium. And then that's when the CEO found out that in revenge, the terminated employee had introduced malware into the donor database so that confidential information from the major donors had been accessed by an overseas hacker. So there you have it, a day in the life. Margaret, can you take us to the first substantive slide? So I'm going to go real quickly through a couple of legal provisions that are sometimes mentioned by nonprofit directors and officers to say, well, that scenario, the directors and officers aren't going to be liable for any of this. There is indeed a California Corporations Code section, it's referenced here, that purports to protect directors and officers from personal liability for damages. However, this particular exclusion applies only to volunteers. There are a number of limits and exclusions to it. And in order to take advantage of it, the director or officer has to show that the nonprofit itself had general liability insurance with minimum coverage. Note that there's also similar protections for mutual benefit. Well, these same protections apply to public benefit and religious corporations in California. And then finally, not all nonprofits are corporations. Some are unincorporated associations. My site there, this is a program that has something for everyone, and some people look for mistakes. That citation, it should be 18605, not 1860.5. But anyway, unincorporated associations and charitable trusts aren't covered by this nonprofit corporations provision. The section 18605 of the California Corporations Code does say that directors and officers won't be of unincorporated associations are not liable solely by reason of being a director or officer or member of an unincorporated association. But that doesn't really mean anything, as we'll see as we go along. Next slide. There's also federal statutory protection. The Volunteer Protection Act in the federal code it purports to protect directors from, not directors, but volunteers from liability caused by their negligence within the scope of their volunteer duties. It doesn't apply to operations of a vehicle. There are exclusions for criminal acts and acts under the influence. And also importantly is this limitation only applies to the personal liability of the volunteer, not the liability of the organization. Next slide. So the final piece under the California legal protections, the nonprofit corporations are permitted to indemnify their directors, officers, and agents if they choose to do so. Not all nonprofits do, and there are limitations on the circumstances under which indemnification is allowed. So you can see the details of that, and there's a lot more in the corporations code that I won't bore you with, because it actually becomes somewhat beside the point, particularly if the organization doesn't have the resources with which to indemnify the director or officer or agent. So with that, that's the legal background. Yes, there is something there. No, it's not enough. So with that, I'll turn it over, hand off to Mary to go into some of the nitty gritty here.
So thanks, Cynthia. Next, Margaret. So for anybody who thinks nonprofits don't need insurance, the answer is they definitely do, and they need it almost as much as for-profit corporations do. As Cynthia pointed out, the fact that they're a charity only provides some very limited protection, and only really for directors and officers who have acted properly and in good faith. The nonprofit is still required to have workers' compensation. If they're handling autos or driving as part of the duties of some of their staff member, they could be required to have auto liability insurance. You also have to realize that if they've undertaken, like with the vendor of the tent, or contracts with the outside event coordinator, there may be requirements in there which say that the nonprofit is going to have certain kind of insurance to protect that provider if something goes wrong. Similarly, the person who agreed to host the event, if the nonprofit may have some kind of informal arrangement where they said they would take care of things. So there are a lot of ways, either legally or contractually, that the nonprofit may actually be required to have insurance. Also, and I'm not going to spend the time right now sorting through all the different lawsuits that you could have based on this true, conflagration of horrors, but whatever happens at the end of the day, somebody, and it's probably the nonprofit, is going to be spending a lot of money on defense costs trying to sort this all out. Also, although there is some protection for directors and staff under the various state laws, certain things like the fact that a director is harassing and bullying a staff person, very unlikely to be protected under the statutory schemes that Cynthia talked about, and probably not the nonprofit either, if it either knew something was going on or turned a blind eye. So a lot of different exposures here that people should be aware of, a lot of which, certainly not all, can be taken care of or at least minimized if you have insurance. The other thing is we chose a special events scenario, because with a special event, the organization may be taking on exposures and doing things that aren't really in its wheelhouse. Transportation, liquor liability, facilities issues that a smaller nonprofit may not normally have as part of its risks. So they may not have in their sort of basic insurance package, and they should be considering whether or not they need that extra protection. So now that we've talked about what you need insurance for, why you need it, I'm going to ask Joan to really focus a bit more on the key risks that she sees, which are nonprofits deal with.
Oh, thank you, Mary and Cynthia, and thank all of you for participating today. We really appreciate it, and appreciate your being risk aware. In terms of nonprofits, and the risks that we're seeing are very serious, and that are triggering insurance claims or liability issues, I would say the first and foremost is anything related to child abuse and molestation. So we're seeing a real increase in the number of cases that are happening, not only from many years ago, but also in today's world, where any of you who are working with kids or teens or families know that anything regarding children is first and foremost your number one safety issue. And you have to be really concerned not only about adult on child abuse issues, but also child on child. And so issues pertaining to bullying or harassment, we call it kid on kid issues, are a serious concern for an organization and is something that needs to be part of your risk management program. But by far the more costly and serious cases involve a predator or an adult on child interaction that's inappropriate and sexual in nature potentially. Mary brought up in her case story a little bit about autos. So a lot of nonprofits and organizations that Farella works with have what we call a non-owned auto exposure, meaning you may not own any autos, but you have a huge auto exposure in staff or volunteers or vendors that are driving on your behalf. So that's an area now where auto claims have become very costly in terms of medical expenses, and there's an exposure even when you don't own autos that you have to think about. Cyber liability, as many of you know, is in the news every day with breaches and hackers and all kinds of things that can happen not only to your own networks, but that damage you or your staff or volunteers can potentially cause others. So in the world of cyber deception right now and cyber extortion are key issues that a lot of nonprofits are seeing their staff get ensnared in ransomware attacks or in the fraudulent parting of money, where somebody receives an email saying the CFO or the CEO is requiring a payment of $40,000 be made immediately to so-and-so. And you'd be really surprised how many good, loyal staff members are very susceptible to that and take it seriously and therefore transact fraudulently and send money where they shouldn't. Employee and volunteer safety is key to all of you. You depend on your staff, you depend on your volunteers, and when they get hurt, that can be a costly proposition. So we're seeing a rise in medical costs on workers' comp claims for employees. And then the same can be true of volunteers. And so all your organizations need to think about what is your responsibility. By law, volunteers are not subject to the work comp law of California. So we do recommend that you consider having a volunteer agreement where they sign a waiver, they take responsibility for any injuries that occur other than something that's caused by your gross negligence. Special events, which Mary tells that great story on, are always a big source of exposure for nonprofits. And as events get more complicated, you're trying to be edgy and trendy and do things that are unusual. We didn't see much of this, obviously, in 2020 with COVID, but we will start to see this again in 2022, most likely, where organizations, in an effort to have a really fun event, can bring in trapeze or artists that are performing from hanging from the ceilings with fire and all kinds of pyrotechnics. It can get really complex, and there's a lot of liability and insurance issues with all of that. The good news is most of it can be mitigated, but it is a time when your organization has to really be careful and think about the vendors that you're hiring and contracting with and what they're doing. And then lastly, what we've seen in 2020 with a lot of the social justice issues are some really serious movements that have a lot of controversy associated with them for one reason or another, and how your organization responds to social justice issues and how your employees and donors and vendors and stakeholders all respond can all put you at risk. And it is really important for you to have good policies and procedures on how you monitor your internet, your social media platforms, and when you allow discussion and when you will take things down and on what basis, and what groups or people in your organization would be responsible for monitoring that so that it's not discriminatory. So those are some things to put on the radar in terms of looking at what's on the radar in terms of risk and nonprofits and what you should be looking at for the coming year.
So it's really a challenge for any organization, but particularly for nonprofits, is What kind of insurance do you need? You can't just call up Joan and say, hey, I just want an insurance policy that's going to take care of all my risks. They come in different pieces, and sometimes they're combined, sometimes they're separate. And so I was just going to run very quickly through some of the more common types of policies that you will see. Cynthia had mentioned earlier commercial general liability policies, which will cover the organization and its employees and directors if they get sued. But it's limited to situations where there are claims for bodily injury or property damage and libel and slander. It just doesn't include some kind of general, you've made somebody angry, they're going to sue you. The policy just doesn't automatically kick in. Workers' compensation, as Joan mentioned, will take care of the risk for your injuries to your own employees. And sometimes, a client will say, oh yeah, I have employee insurance. Well, as you can see, there are a number of different kinds of employees insurance. There's worker compensation, which takes care of injuries to the employees. There's employment practices liability, which will take care of claims such as discrimination, harassment, bullying. There's employee benefits liability, which takes care of mistakes that are made in the administration of the employee's benefits. And then crime employee dishonesty, which you would hope would cover situations where an employee is misusing funds of the organization. The management liability will protect the directors and officers for their mismanagement of the company. I didn't add to the hypothetical here that at the end of the day, a couple of the board members looked and decided that the entire organization was being run improperly, that certain board members were not undertaking their duties. I mean, you could have even more lawsuits, coming out of the fiasco that we're talking about, and management liability would be another way to cover those risks. Next. For nonprofits who provide services to other parties, like a social services organization, organizations working with children, legal organizations, they should consider whether they need some kind of errors and omissions coverage to protect them in performing those services. The cyber liability for the hacking incident, nonprofits who operate any kind of websites, platforms, any publications, their general liability coverage, even though it will cover libel and slander, may not cover it if it's done in connection with the nonprofit's publications. So then you need a separate media liability policy. We've talked about auto, property policies to protect your own assets, particularly if you own a building or some other real estate. And then I did not mention in our hypothetical that in the course of the SUV knocking the tent over, a canister of butane, kerosene was knocked over and seeped into the grounds of the estate. That's not going to be covered under any of the other above policies unless you have pollution coverage. So now that we've frightened you and confused you, we're going to have Joan explain how to make it all better.
Oh boy. Oh, that's a tough one, Mary. Well, I've been having conversations with a lot of our clients, and I know a few are on the phone, but the idea that quality insurance, I put the words up here, quality insurance is not a guarantee. And a lot of you have very good quality insurance providers. You have very broad scopes of coverage, high limits, fairly low deductibles, your good risks. But it doesn't mean you're going to always be able to get that in the future. And we're seeing a really, really tight market. And I'll show some slides in a second about that. And it's the most chaotic, turbulent insurance market I have ever experienced. And I've been in the market in the insurance world for 3 decades. So it's really seriously, capacity is limited. We'll talk a little bit about that, but it's just very important to not take your insurance program for granted. And I encourage clients to protect your insurance program and look at it as a newborn baby with a blanket wrapped around it. And you don't want to use insurance as not sure where that. You don't want to use insurance as a charge card. I know some people say, well, that's why I buy insurance, or I have a small claim, put it into insurance. But over time, every claim costs you money. And so those of you who have auto or homeowners insurance know that if you have too many claims, you are going to get canceled or non-renewed, your premium's going to go up, and you potentially might not have coverage. So the same is true on commercial insurance for nonprofits. You want to keep your loss record as clean as possible and save the claims for things that are much larger in terms of dollar value or are liability related. Some of those you have to turn in no matter what, but you want to be cautious and protect your loss record as much as you can, because ultimately that will help keep your premiums and rates down. Those of you who negotiate insurance know that cheap is expensive. And if you are not insuring your organization for things like abuse and molestation, liquor liability, pollution, if you have an exposure with chemicals, some of the areas Mary talked about with D&O insurance or employment practices, you can really cause your organization to go out of business. You have to be able to have the right coverage at the right price for the right exposures that you have. So it is important that you work with a good broker that's involved in your organization that really understands what you're doing on any given day, not only what's obvious, but things like the special events or when you're collaborating with others, or if you're looking at funding certain projects, what is the risk associated with that? Sometimes there may be none, but sometimes there may be some. So you just want to be able to evaluate that and know that at all times you're protecting your organization as best you can. One of the biggest things nonprofits do is take on the risk of others. So you're all very noble, good intended people, and your organizations do great work. You really help a lot of people in your communities, but sometimes you take on more risk than you should or that you need to. So having somebody like Farella and Cynthia and her team and Mary to be able to say, wait a minute, let's think this through. Let's look at the contract. Let's make sure that we're putting liability where it belongs is the best way to go, because over time, if you're paying claims that don't belong to you because you haven't contractually eliminated that exposure, or you're taking it on when you shouldn't, you will cost your organization a lot of money. And that's dollars away from services and your mission. So I always say to our clients, we don't want you wasting money on insurance. We want it to go to help all the people you're trying to serve and the community. But we do realize there is a certain cost you have to just be responsible and good stewards of your organization. So the contractual issues, we'll talk about those a little bit later as well. It's very important that the contracts be looked at very carefully, and some really prominent organizations have some really onerous contracts that they will push on you. So I don't want to call out certain people, but I will even, say at certain times, somebody like the American Red Cross has given organizations like yourselves a contract, and it's always in their favor, but the client has to be careful to look at all the provisions, not assume that it's balanced and fair, that you have to look out for what you're committing to in those agreements. Next. So I just have a couple of headline story slides. These come from Advisen, and I always think they're good for you to have to just show that it's not just me or your insurance providers that are saying, hey, the sky is falling. But every week we're getting news articles from the trade press, whether it's the Wall Street Journal, Risk and Insurance Magazine, Advisen, all kinds of financial publications are saying insurance is a nightmare. So a lot of you, as your renewals come up this year, I know a lot of you have July 1st renewal dates, you're going to see pretty significant rate increases in certain lines of coverage. And most particularly would be directors and officers, umbrella liability, and some professional lines of coverage. And we'll talk about why that's so. But this article is basically saying lines are up across insurance costs for all lines of coverage are up about 10%. So if you're seeing 10% as an average, there's many clients that are seeing 20, 30, 50% increases on certain lines of coverage. today we just delivered a renewal with a 48% increase on directors and officers liability. And the client was so happy that anybody would insure them, that they could still retain a $10 million limit of liability, and that they were with very prominent insurance companies. So that's kind of an extreme case, but they were a risk that had no losses, no D&O losses ever in their record. And that is the story. Now, we had scoured the market. We went to over 24 insurance companies, and we actually had to layer their programs. So whereas one insurance company last year took the whole 10 million, this year we had to have 2 providers do that. So we'll see more of that.
Joan, was that because of the size of the coverage they were looking for, or I mean, you said that they didn't have any losses.
So here's where sometimes the industry segment that you're in makes the difference. And even though they're an advocacy group, they are involved in the healthcare space and they are political. So having those 2 industry segments in their mission immediately puts them in this light with underwriters that, well, we don't want healthcare. We don't want anybody involved in political situations. So just by virtue of who they are, created a situation where there was not a lot of bidders who wanted to look at it.
Wow.
So sometimes you can just be in the wrong place at the wrong time. But the good news is that there were underwriters, especially their incumbent, who understood them, liked them, and did everything they could to give them the best deal that was available. So they had said, if you were a new customer, we would have only given you a $2.5 million limit, not a $5 million limit. So, capacity is really becoming a problem. And I'll talk about that in a second. The next slide, again, is just to say, this one just came out in April, that the commercial rate increases in the US continue to climb in the first quarter. And this one has them even higher at 14% on average. Work comp is the line of coverage that's going up the least, which is good because for years, especially in California, work comp was out of control. But I share these articles because it is important to know that this is affecting all businesses in the US. It's not just California. It's not just nonprofits or schools. It's everybody.
John, a question about the comp. Is that COVID related or just coincidence?
Comp, there is concern about if employees contract COVID at work, that would be a compensable work comp claim. Mm-hmm. They have to show that they got it at work, right. But there is concern as things reopen, as people get lax on the COVID protocols, that maybe that people could contract COVID in spite of all that's going on. So on the next slide, the current market trends are a little disconcerting, as some of you know who live in Marin County or in Santa Cruz or anywhere there where there's a wild and brush fire exposure. There are serious insurability issues. So we're seeing that areas like Lake Tahoe, a lot of parts of California have become very difficult to insure, but not only from a homeowner standpoint, but for commercial businesses. So I share that with you because fire is the one insurance peril that is insured. And so when you see in the news that all these people lost their homes or businesses, the insurance industry is paying the claims because that's all covered. But then typical of insurance companies, what do? They raise the rates, or they non-renew and restrict coverage and say, we're no longer going to provide coverage in this county or this area. We're retrenching or we're just pulling back. But for those of you who provides funding or sponsor organizations, it is important to know what your clients are up against. So if you are going to be donating money or sponsoring organizations as a foundation, if you're in the affordable housing sector, or you are in youth programs and want to send kids to camp, the camp might not be able to get insurance because of where they're located, or the housing units, because they're next to a brush zone, may see their insurance go up astronomically, which puts their financial situation out of balance. So fire insurance rates and all property rates have gone up significantly. Social inflation is something that Mary and Cynthia know a lot about. In terms of liability claims, when they do happen now, we have seen just a exponential exponential cost on a liability claim. So a slip, trip, and fall claim that might have gone for $25,000 or $50,000. Somebody falls down the stairs, somebody slips on a floor in your building. Now those can go for $500,000. We have a few sidewalk claims where people trip in front of the nonprofit. We had one that settled for $400,000 recently. And so the dollar amount is huge. And we're also seeing a lot with parking lots. So, you know, there's just a lot going on with premises issues and the dollar amount of what these claims are worth. So insurance companies are very concerned about what's going on with that. We talked a little bit about auto. Distracted driving is on the rise, and the main culprit in auto claims and auto accidents. So everything you do within your organizations to make sure that you have a distracted driving policy, meaning drivers should not be on the phone. They are not allowed to text or talk while they're driving, especially if they have passengers, is really important. So the other item, we are seeing a reduced capacity and reduction in insurance limits. And a lot of insurance companies are saying, we will take some of this risk, but not all of it. So what we're seeing much more of in property that's wildfire exposed, or even on liability with umbrellas, if you've previously had maybe 10 or $20 million in limits, we're seeing underwriters say, I will take 5 million, I will take 1 million, I will take 3 million. And we have to build what we call towers of liability or property insurance. So we actually have one very prominent school down in Southern California that's in a brush zone that literally needed 10 insurance companies to build up the property capacity that they needed to insure their building. So we're seeing a lot more of that. It's costly, but it's the strategy, and it's the only way you can get the limits that you need in some cases. The same is true on the umbrella, which is over your general liability and auto. We're seeing the need to build up towers, as they're called, for buying higher limits of insurance. Many underwriters are restricting sexual abuse coverage. It's very difficult now to get that in the umbrella. You can get it most typically in the $1 million general liability policy that Mary spoke about, but it's going to be challenging to get high limits of use in the umbrella. And then I know some of you have asked questions about the professional liability. Anybody in healthcare, financial services, some other higher risk type fields is finding capacity reduced again. So we have a lot of funding requirements on some organizations with the county or the state that require certain limits on professional, something like 2 million per occurrence, 4 million aggregate. And that's getting hard to come by. So I'm pointing that out for a lot of you who sponsor organizations or look at, funding different types of clinics or healthcare or housing, that it's becoming very difficult to get these high limits. We talked about cyber breaches and ransomware. Those claims continue to rise, and the cyber market is not really priced adequately to handle all these claims. And that's one of the problems, and why we're seeing rate increases, is that they price their product on not having claims. And of course, there's lots of claims. So insurance companies overreact, and they tend to double and triple premiums when they don't feel comfortable or certain about what the future holds. And that does bring up an interesting concept, that insurance is really the only industry that I can think of that has to price its product before they know what it costs. And therein lies the problem. And insurance companies are not very good at their core business, which is underwriting risk. They're better at investments. So when we're in a tough market like this, they have to really buckle down and pay attention to their core business. And it's really hard for them. So we'll talk a bit about what you can do to help make their job easier and get a better outcome with your rates and premium. But not being able to know what your product costs when you're pricing it is a problem. And it really is, insurance is legalized gambling. And the underwriters are basically guessing on what your claims are going to be for the year and hoping they're right. So whatever you can do, and your broker and insurance professionals to help them feel comfortable, will help you have a better outcome. And then we did talk a little bit about directors and officers liability and employment practices. This is another area where there is a lot of litigation, and there's a lot of unhappy employees out there. When COVID occurred and companies closed down or shut down or slowed down, people were furloughed, they were laid off. And as people have been brought back, people's feelings are hurt. Why did you bring her back and not him? Why did you do this? Why did you pick them over me? Why did you bring back this category of people and not others? So there's a lot of unhappiness in the workforce in terms of how the COVID reopening is going, and underwriters are very concerned about employment practices claims. Next. So with all that good news, what can you possibly do? There is hope on the horizon. I feel really strongly that when you're best in class, you're going to be able to get good insurance. It might cost a bit more, but you're going to be able to have quality insurance covering the things that you need. I've been an underwriter for a long, long time, and I always can spot a good risk. And I encourage all of you to be A students on paper. It's really important how you answer the questionnaires, how your loss record looks. You just always want to look good in writing and in paper. So underwriters generally have a couple of minutes to size up the submission when the broker sends all these applications and paperwork, your loss record, all these supplemental questionnaires you've had to complete, and basically the specifications and applications about your coverages. It's pretty easy to separate the good from the bad. So underwriters want to see that you've performed well over the past 5 to 10 years. So we are seeing underwriters ask for loss histories beyond 5 years. So especially in the abuse area, they are going back 10 years. So some of you may not know, but underwriters look at what is called your loss ratio, and that's your losses divided by your premium over a certain time period. It's a little bit like your credit score. So they are looking for you to have a loss ratio under 40%. So some classes might say under classes of business, it might be 25%, others it might be 60%, but I just use the 40% as a guide. And so you should talk to your broker about that and say, how do we fit in this picture? How would we be perceived? And if you have a bad loss ratio, there are ways to explain it. Was it the wildfires? So anybody who's had $1 million wildfire losses, of course, is going to have more than a 40% loss ratio. But there's ways to explain it. Even if you've had something really bad happen, a drowning, a serious abuse issue, or a serious liability claim where somebody slipped and fell in your building and fell down the stairs. There's ways to explain it and say, hey, here's what we've done. Insurance underwriters love the mea culpa of what did you learn from it? What are you going to do differently? So there's a lot of resources and tools to help you with that, both through Farella, through your broker, through your organization, to just be able to explain what happened and what you're doing to make sure that doesn't happen again. What underwriters don't want to see is uncontrollable risk. So that's where you say, well, how could we have figured that out? How could we have thought that the tent would collapse? Well, if any of you are ever getting a tent you should figure it's going to collapse. I would go into it, and how are we going to prevent it from collapsing? So you have to, underwriters want to know that you're risk aware, that you're thinking about the risk. And these are the things you're doing. We hired a prominent rental company who's expert at putting up tents. We checked it. We had a facility person that was just in charge of making sure the tent was being put up properly. We had a person in charge of making sure the caterer and the bartenders, the transportation people, that everybody was where they were supposed to be, doing what they were supposed to be doing. So those are all things that help you control the risk. What underwriters don't want to see is just, well, hey, stuff happens. What could we do? It was, once in a blue moon claim. And underwriters are like, no, there's not really once in a blue moon claims there. Most things can be predicted. So they look to you to be able to be risk aware and control that. Another area is for those of you who have a lot of property risk buildings, or you work with clients who do, it's really important that their sprinkler systems are all working and tested. We've been finding with the fire claims, a lot of people's sprinkler systems and alarms are not working properly. And that is a huge problem. The biggest problem is it's a life safety issue. So sprinkler systems are there to save lives. And if you have a sprinkler system and people in the building and it's not working right and people die, you're going to have a huge problem. So I would really work with all of your facility teams, or those of you who know that you have that kind of risk, or and all that. You have to take that really seriously. Those are all supposed to be tested annually, and they need to always be working. Risk transfer in the story that Mary described, that's risk transfer galore. There's so many places where contractual agreements should be in place to pass the liability on to the party that is providing the service or the operation or the product. So bartenders who serve alcohol should be taking the liquor liability risk and covering you as additional insurers. So if somebody drives home drunk and says they were overserved, you are protected under that bartending or caterer's insurance for liquor liability, because you did not serve the drink, they did. So you're always trying to put liability where it belongs, and that can be hard to do, but good contractual agreements are how it's done. And then insurance is how that's funded. Sometimes people think the insurance is the dog wagging the tail, but it's really the contractual agreement that's more important. And then insurance is how they fund that obligation.
I just want to add there, Cynthia and I are obsessed with tents because we spent hours, several days before an event. Fortunately, this tent did not collapse, but looking at the various agreements. And the one thing I would really emphasize is that you're right, you want to limit what risk you are assuming, but you also want to make sure that if for some reason you have assumed a risk under the contract, that is included in your insurance. You want to make sure that because you'll read a contract and it goes, oh yeah, we agree to provide $5 million in general liability coverage for X, Y, and Z. And then you don't want to later find out after something's gone wrong that nobody had that $5 million of general liability coverage. So just, even if they're not perfect, just make sure they match. That's
a really good point. Years ago, I had a youth service organization that rented buses and committed in the contract that they would be providing the bus insurance for $5 million. And guess what? Their policy did not cover them for $5 million. And so,
and another thing that I see often, because I don't know why, but people think I like to read contracts. And you'll have these complex situations, not just special events, but otherwise, where the indemnities and the releases and the waiver language, sometimes it's internally inconsistent in the same document. And it's a lot of vendors and contractors just put out a contract that says we're not responsible for anything, or we're responsible only up to the amount that we've been paid under the contract. So it's just really important to really carefully read through all the contracts that relate to a particular type of activity or event, and make sure that those contracts don't put everything, like Joan was saying, put the liability in the wrong place. And most of those things are negotiable. If you, the nonprofit, are the one that's buying the service and you push back, reasonable, responsible vendors who have good risk management programs have heard the same lecture from Joan and understand that risk belongs with the person who can manage it. So I just encourage people to actually read the contracts, or if you're not sure what it says, ask a lawyer or your broker to explain what's going on.
Yeah, great point. And the limitation of liability is popping up in a lot of contracts. We're seeing this, especially in the past year, where organizations are trying to limit their liability to the fees that you are paying them, which could just be $2,500. And even though you have all these insurance requirements and asking for additional insured status and millions of dollars of liability, it's all negated by that clause. So yeah, that's a good point. I guess lastly, in terms of underwriters and how they perceive things, is a lot of you have really good risk management programs, but it's important that they are effective. So just having something in writing saying this is what we do, this is how we do it. If you're having a lot of claims from different operations, there's something wrong with the risk management program. It's not working effectively. So it's not just enough to say we have a risk management program. Is it effective? Is it checked, are refreshed regularly? Are people following it? And are you enforcing it? Because, talk is cheap, but the proof is in the pudding. And underwriters really want to see that the risk management program is actually working, and you see that by your claims history. So again, your loss record is sort of the key to everything and how an insurance company right now is viewing you. So that's the number one thing they're looking at, in addition to what your operations are, your venue. Unfortunately, California is a very litigious venue, and a number of insurance companies are backing off from providing coverage here. So you'll see that if you were in Washington or Oregon or Nebraska, things would be better. But California is a problem in just the value and the number of claims. So that is a little bit of an issue when you're going into the market. But overall, I would say that there's a lot you can do to help mitigate some of these increases in the impact of the insurance industry. And you just have to know right now that the insurance company is in the driver's seat. That's not always the case. We've had a soft market for many years where all of you were in the driver's seat, but it's changed right now, and it'll go back. Insurance is cyclical, but we just have to help all of you get over the hump and be able to look at your coverage and be able to buy the most cost-effective program you can. And in some cases, it does mean reducing limits a little bit. We have had clients who have had $20 and $25 million umbrellas, and they've decided to lop off 5 or 10 million this year just for a temporary measure to just save some money while their operations are still scaled back a bit, and then revisit it. But as a broker, I know a lot of brokers, they want to do a good job for you, and they are always wanting to save you money, which is good. We always want to save you money, but sometimes they maybe put the cart before the horse and think, oh, I don't want to present this option because it's going to cost more, or I don't want to present this coverage because I know they won't buy it. They're really, trying to scale back on insurance costs. But I would encourage the broker, just say, no, present all the options and let us evaluate what we want and don't want, because you may want to buy a certain coverage based on what your exposure is and where you feel the risk is. And you just don't want the broker, predetermining, don't present it because they're not going to buy it, or, just making a decision that you might have made differently. So ask them to just, hey, present all the options and we'll decide what's best. I see some questions popping up, but are we going to save those for the end?
Yeah, let's get to those at the end.
Yeah.
Those are fine to hold.
I think in the interest of time, and so we can do some questions, Margaret, if we could skip to it's slide 18, best practices for claims. think the slides before that are more just what's in the policy, and those are certainly things you can talk to your broker about. So these are the, you've got the best insurance you could, you have a claim, and things that unfortunately people often come to me after the fact, and it's hard to fix. So just some really basic things to think about. One is, and there's a balance here because, as Joan pointed out earlier, you don't want to over-report so that the insurance company thinks you're just a disaster waiting to happen. But let's talk about the situation where the terminated employee in our hypothetical says, just in an email, I've been harassed, I've been fired unfairly, and this needs to be made right. I've had situations pretty close to that where the insured did not interpret that as being a claim. And then later, the employee brought a lawsuit. And because of the nature of how the coverage works, once you have a claim, and a claim isn't necessarily a lawsuit, in a policy, a claim can be a written demand. If you don't report that written demand during that policy year, then you lose your coverage. So I think particularly in the area of employment coverage, which is so expensive and where people are hurt and angry and they say things, you think you may have smoothed it over and it's gone away, but it comes back later. And if it comes back in the next policy year, you lost coverage. The other thing is to make sure that, again, because you're, as a nonprofit, maybe as part of your mission, you want to make sure you're taking care of people. You want your donor base to be happy. You want your volunteer base to be happy. Make sure that once you have a claim, before you make any commitments, you're talking to the insurance company about it. You can't call up your volunteer, the director who borrowed the statute that got smashed when the tent collapsed, and say, don't worry, we will pay for it. That may be your goal, but you have to make sure that you have struck some kind of agreement that at a certain point somebody is going to try to hold you to. And the insurance company would say, well, it's nice that you did that, but our policy requires that you get our consent before you make agreements like that. We do not have to pay it. You do want to make sure you're cooperating and providing the information that the insurance company is asking for, but also keep in mind that there may be certain privilege information that you don't want to provide to the insurance company because it might raise a coverage dispute. Think about, consult with the lawyer before you just start turning things over willy-nilly. Whenever you have a claim, you're likely to get somewhere between a 10 and 15-page letter from an insurance company saying, here are all the reasons why we may not cover you. And a lot of times it's just listing the entire policy, saying some of this may apply, you may not be covered. That's not a reason to panic, but I also think that you shouldn't just get a reservation of rights, look at it and go, I'm going to deal with it later. You need to, and this is somewhere where a broker or a lawyer can help you, because Joan could look at a reservations of rights. I could look at a reservations of rights and look at what the carriers are saying, what they're reserving on, saying, you got a problem here. This particular issue is going to be a big problem. Or we could look at it and say, this is like just getting spit out of the word processor. This is not a big deal. Do not worry about it. It's all under control. And then the last thing too, in so many of these policies, the insurance company controls the defense and they get to appoint the counsel. You don't get to appoint the, it's not like somebody who's on the board is a lawyer, their law firm will defend, but it just doesn't work that way in the insurance world. And so it's very important that you recognize that you will be dealing with an insurance defense counsel who is not necessarily familiar with the organization, and who somebody who you aren't familiar with, and just sort of make sure that you are engaging with them, that they know who you are, that they know that you're looking at the case, and that you expect them to take care of you. So with that, Cynthia, do we have time for some questions, or how do you want to?
I hope so. So I think we've now concluded the formal part of our program.